We all know rating agencies played a huge role in fueling the 2008 crisis. Their job was simple: check complicated mortgage-backed securities and tell investors how safe they were. Instead, they did the opposite. They gave the highest ratings to these MBS, and investors trusted those ratings. In simple language, the people who were supposed to protect investors, they themselves helped to sell the dangerous products to investors. So in this video, we will see in detail how exactly rating agencies played this role in the 2008 crisis. There were mainly three credit rating agencies: Moody's, Standard & Poor's, and Fitch. They were supposed to be independent judges. Big investors like pension funds and insurance companies relied on their ratings to decide what to buy. A AAA rating meant very safe. Investors all around the world depended on the ratings given by these credit rating agencies. A AAA stamp could turn a product into something that is sold easily around the world. This made these agencies extremely important. The normal process of making and creating an MBS was that banks bought thousands of home loans and bundled them together. They would then slice these bundled loans into layers of risk called tranches. Once the tranches were created, the bank would send the entire structure to a rating agency for an independent evaluation. At least, that's how it was supposed to work. But the banks and rating agencies did the reverse engineering on these MBS. Let's say a bank created MBS and gave them to rating agencies to rate them. The rating agencies said it is all filled with junk, so it has a CCC rating. So banks would ask them, what should we do to get the AAA rating on these MBS? Then the rating agency would suggest to them that they should add some good quality loans and put some cash reserves ready to absorb initial losses if some people defaulted. While giving ratings, the agencies had given too much weightage to these cash reserves. If the MBS had cash reserves, they would certainly get AAA ratings. The core rating manipulation started with the methods used by the rating agencies. They used tools that assumed home prices would not fall everywhere at the same time. They also assumed that if the defaults are happening, then they are not linked with each other. Those two assumptions made MBS look much safer than it really was. Even if the people whose loans were in that MBS were defaulting, the MBS still held those high ratings. The banks would restructure the MBS as told by rating agencies and run these models until they got AAA ratings. This was reverse engineering in the clearest form. The desired grade came first. The product was engineered around the grade. It's like a teacher telling his students to write the answer again and again until he gets the perfect grades on the test. Now, it was not that banks changed these MBS drastically, they just added some good loans, added some cushion in the form of ready cash, and used some other tactics that made these MBS look safe on paper. But the underlying issue of bundling bad loans together was still there. So these MBS were safe just on paper. In reality, they were just ticking time bombs. The people working at these rating agencies knew the MBS were rated falsely, because after the collapse, investigators found internal emails of these employees. In one of the emails, an employee wrote, "We rate every deal. It could be structured by cows, and we would still rate it." So it did not matter who and how banks were creating those MBS. Another employee's email said, "This deal is so bad it could blow up in our face. Let's hope we're all retired by the time it does." So they knew that they were manipulating ratings and knew the housing market would crash at some point. In another email, an employee described the rating process as a race to the bottom, saying, "We're rating deals that we know are not good, but if we don't, someone else will." These emails were not from outsiders. They were the admissions from the people inside the firms who saw the work and understood the limits of the models. The emails show analysts joked about manipulation of ratings, but kept issuing the ratings anyway because the business pressures were real. This pressure on the rating agencies to rate higher came from the business they got from the banks. The banks paid these rating agencies to rate those MBS. If one agency refused to give a high rating, the banks could easily go to their competitor. This sale of ratings created a problem, because the rating agencies that were too strict lost business. So there was a great incentive for these rating agencies to be flexible. So why would the rating agencies go along with this? The answer, as it often does, comes down to money. And we're talking about a lot of money. Now let's see how much banks paid to rate these MBS and CDOs. But before that, let me tell you one thing. It is normal and standard business practice that rating agencies charge fees for giving the rating for the product that banks created. So getting paid was not the issue, but not rating those products correctly was the issue. But the amount of money these rating agencies made from these banks will give you a clear idea why these rating agencies wanted to be in the good books of these banks. For a typical mortgage deal during 2005 and 2006, the rating agency fee was often in the hundreds of thousands of dollars. It was roughly $150,000 to rate a simple MBS and about $400,000 to $500,000 for a normal CDO, and around $700,000 to $750,000 for a complex synthetic CDO. If the MBS had huge value, then sometimes rating agencies also charged a small percentage of the total value as fees. The rating agencies' pay didn't just end with that one bulk payment. They also charged ongoing monitoring fees. The monitoring fee was paid to keep an eye on the ratings of these MBS. If the market fluctuates, those MBS ratings need to be adjusted for investors. It is like buying a car and then paying for an annual service plan. Your initial rating is the big car purchase, and surveillance is the subscription for servicing that keeps paying every year. These surveillance fees were smaller than the initial fee, but they kept coming as long as the rating remained in force. So a single MBS gave a large upfront fee plus a stream of annual income. Those recurring payments turned each deal into long-term revenue, not just a single sale. Because of those two income streams from a single product, the demand for rating those MBS exploded in value. In the early 2000s, rating these mortgage products was a small part of these rating agencies' income, but by the mid-2000s, it dominated their growth and income. Moody's and S&P each rated roughly 10,000 MBS between 2006 and 2007, about 400 MBS ratings per month per agency, and the CDO market produced several hundred deals a year, with synthetic CDO issuance rising into the tens of billions a year, meaning dozens of synthetic deals were hitting the rating desks each month at the peak. Moody's revenue jumped to hundreds of millions a year at the peak. These three big rating agencies went from under a few $100 million in revenue in the early 2000s to more than $6 billion a year by 2007. In simple language, what was once considered a small-time, very specific niche product became a cash cow for rating agencies. This is the reason why giving AAA rating to these MBS meant making millions from these banks. When millions of dollars are at stake and steady, recurring income follows through, the incentive to keep business coming from these banks becomes important. So the mechanics and the money worked together. Banks engineered MBS to meet the bare minimum ratings requirements. Agencies charged large fees and then kept collecting recurring payments. Analysts who understood the risks still issued ratings. The system was set up in such a way that the AAA ratings were something banks could buy. A concrete example of this is how CDOs were created and rated. The middle, riskier, unsold tranches from many mortgage-backed securities were combined into a new CDO. These new CDOs were then rated as AAA. In other words, BBB level pieces were repackaged and relabeled as AAA on paper after another round of modeling and structuring. When defaults rose, these CDOs collapsed like a house of cards. This is why many investors felt betrayed. They relied on the AAA rating as a reliable signal of safety. Imagine a pension fund manager in Germany or an insurance company in France trusted these ratings and thought that they were very safe. As a fund manager, he did his job of analyzing risk from the given methods. He can't analyze individual loans in MBS as he has to trust the ratings on those MBS. So when the market collapsed, that pension fund from Germany lost billions of dollars, wiping out the pensions of common people. Traditionally, investments that have AAA ratings have less than a 1% probability of default. But in 2007, the vast majority of MBS and CDOs with AAA ratings incurred substantial losses. Some failed right away. Analysts then figured out that over 90% of the AAA ratings given to subprime MBS securities from 2006 to 2007 were later downgraded by the credit rating agencies to junk status. Moody's rated 42,625 mortgage securities AAA from 2000 to 2007. By 2010, 83% were downgraded. In 2015, S&P paid $1.37 billion as a fine for manipulated ratings, and in 2017, Moody's paid $867 million for the 2008 crisis. Despite being fined heavily, their stocks recovered quickly, and even today, 95% of the ratings are done by the very same ratings agencies. If you want to learn about the 2008 crisis from start to end, then you should check out this video.